and welcome to the Office of Economic Development Business Information Session. My name is Margaret McGee, and I'm the Business Services Manager. Business services assist entrepreneurs and business owners in starting and growing their business. We help in navigating through the different departments within city government to obtain permits and licenses. We also connect the business community with organizations that can provide technical assistance, incentives, resources, and other programs beneficial in operating a business. One way we do this is to host business information sessions. These sessions are held throughout the year, and topics are gathered from entrepreneurs, surveys, and information we collect from the business community. This is a series of 3 sessions focusing on tax preparation. Today we have Mr. Richard Melanson, a certified public accountant, on behalf of the Louisiana Small Business Development Center. He will share his expertise on basic bookkeeping and QuickBooks. I ask that you please place your questions in the chat box and we'll get them answered in the Q&A section. To keep down distractions, attendees, please turn off your videos and mute your speakers. Now I'll go ahead and turn it over to Mr. Melanson.
Thank you. Welcome everybody this afternoon to a session. We're going to talk about basic accounting. We're going to touch on the importance of basic accounting as it relates to tax preparation for your business income tax return, which then flows to your personal tax return. And we're going to talk about the some of the concepts of accounting from the owner's perspective. This is not a session on how to become a bookkeeper. It's not for the bookkeepers. This is specifically for the business owners to understand what they should be looking for from the accounting reports. So it's really a program for the owners to really enhance your skills when you're looking at your accounting statements that is generated out of your accounting system. We're also going to touch on the fact that it's still valid to have a manual accounting system. I do not recommend it if you're trying to track inventory. The automated accounting programs will do a fine job of tracking the inventory once it's set up correctly. But if you're in a service business, if you're in a business where you're either buying things online and having it drop shipped, or if you're just not in a business that has inventory, there's still a place for a manual accounting system. But the concepts are the same, and it's just what tool do you use? A few housekeeping items. There are no handouts associated with this program. We do offer this program through the Louisiana Small Business Development Center. There'll be a contact phone number at the end of the slides that you can use if you want to sign up and see other training programs from the SBDC, the Small Business Development Center. We serve the greater New Orleans area and also the river region as a whole. And so we offer a whole range of training programs, everything from sales-oriented programs to starting a business. And it's not like we're competing with the city of New Orleans. I've already talked to Margaret McGee about the series of programs that they are going to offer, and their programs touch on things that we do not. So we're not competing with them. We're not replacing what they have. I strongly encourage you to sign up with the additional programs of the city of New Orleans. They're going to have some very useful information for you as a business owner. Even if you're already in business, it's good to know all of the milestones that you were supposed to have achieved when you were registering your business, what you needed to achieve when you're on an ongoing business or annually to keep your business in line with the regulations. There's no reason to have a problem that evolves on its own when you can be proactive and stop that challenge before it occurs. If you have any questions, feel free to put them in the chat box. If I see, I am going to try and read the questions as we go along. If I see a question I can answer through the materials, I'll try and do that. If not, we'll try to answer all the questions at the end. So let's get started. I've already touched base on what is the Small Business Development Center. We offer one-on-one counseling services at no cost to the participants. We also offer ongoing training programs, and we serve as an information resource center. So it's a lot of information resources that we have available to owners who are trying to make decisions about their business. So today's agenda is really 3 parts. We want to help you understand accounting terms and the processes used to create financial statements, because you need to know what's in your financial statements and how that impacts your tax preparation procedures. We want to identify the steps that every business should implement to analyze the current financial position. What should you be looking at every month when you look at your financial statements? We're going to touch on that. And we want to understand the importance of accounting for tax preparation. So to get started, when we look at accounting, the question is, what's the most important information that you have for your business in your accounting system? And every business is a little unique. I have to tell you that I have been an accountant in my own practice for over 30 years here in New Orleans. And every time I take on a new client, I am amazed at how differently that client is running that business compared to all the other businesses I've seen, even other businesses that are in direct competition with that company. Everybody has a unique take on how they run the business, but the basic concepts are very, very consistent across all businesses. You want to buy things at a cost that's less than your price. You want to sell enough of those things to pay for your business and also generate a profit. That doesn't change in a for-profit company. There's a much different perspective for a nonprofit company, for a governmental agency, for a school or an institution like a nonprofit hospital. There are other kinds of entities out there that are generating revenue. But for a business, generally, you want to be in business to generate a profit so that you can afford to continue providing the value that you do provide to your customers on a continuing basis. If you're not generating a profit, you can't stay in business to continue to offer that value to your customers. And so your value goes away, and the value they receive from your competitors may or may not be equivalent to what you are offering. So some of the things that businesses get out of their accounting system are sales reports. How many dollars did you make in sales? To whom did you make the sales? Bank account balance. A lot of entrepreneurs look to their bank account balance to see how much cash they have in their checking account today, so they know how much money they have to spend on inventory, on new fixtures, on hiring salespeople, et cetera, et cetera. Your accounting system may or may not include a product catalog. Certainly, it includes a list of all the inventory items that you sell, and that can be generated into a catalog of a sort. You have your customer names. Yes, customer names are part of the accounting system. Your daily deliveries, it's called invoices that you send out to your customers every day. Sales commission reports. How many dollars do you owe to your salespeople for their efforts, for their successful efforts? Inventory on hand. Not only do your report show inventory on hand, it can show you how quickly during the month you sell all of your inventory on hand. It's called inventory turnover. If your inventory turnover is 1, that means every 30 days you sell all of your inventory. If your inventory on hand is 2, that means it takes you 2 months to sell your inventory. And if your inventory is 5, chances are some of that inventory is stale before you get to sell it. And that's why you see a lot of retail stores, a lot of clothing stores having closeout sales and year-end and season sales, because they bought too many items for inventory. And now they have inventory that's stale and they have to sell it at a discount. So their profits are diminished on those incremental sales at the end of the season. And of course, you're looking for your financial statements to see what is your monthly profit. All right, so there's a difference, and this is a conceptual slide. There's a difference between data and information. Data are the facts and figures that are recorded into your accounting system. The data needs to be accurate, needs to be recorded consistently, and it needs to be reported timely. Those are the 3 points that must be present in your accounting system in order for it to have what we call integrity. If it's not accurate, if it's not timely, and if it's not consistent, it lacks integrity. Doesn't mean that it's telling lies. It just doesn't give you the information that you should be receiving on an ongoing basis to analyze your business. Now, the reports that you get out of the accounting system typically lead you to information. And information is data that has value in helping you to make future decisions. So data is the facts and figures. Information is the results of analyzing the data so that you have information to make decisions going forward. And so your accounting system is really made up of the reports from the accounting system. The main reports are the financial statements, and they're designed to provide a consistent set of information to an informed reader. If you don't understand what you're looking at, it's just paper. And that's why a lot of entrepreneurs will get the financial statements from either their bookkeeper or their accountant. They'll flip to the income statement, they'll flip directly to the net profit line. They'll look at that, put the statements away, and wait till next month and hope it's better. They hope it's better because they don't understand the value of the reports that they have in their hand and how to use those reports to change future events to improve the profit position. And so I will tell you, and this may sound very strange coming from a CPA, that the net income line on your income statement, the net profit line, is the least valuable number on the financial statement package. Why is it the least valuable? Because it's an historical number. You can't do anything to change it because it's a number that was generated in the past. And it doesn't tell you if that was profits generated because you reduced costs or you increased revenue or a combination of both of those. So it doesn't really tell you anything without comparing it to prior periods. So when you look at that number in isolation, it tells you very, very little. It doesn't tell you whether that's a good number or a bad number, whether it should be improved, whether you should be satisfied, and it doesn't really tell you anything because it doesn't have any context. Okay? So if your financial statements are not meaningful to you, then your company may never achieve its full potential. And the accounting systems that we're using, the rules, the procedures, the setup, the structure, those rules have been in place for over 7,000 years. Not a lot has changed. Now, I will tell you, with the advent of the .com industry in the year 2000, with the introduction of computers, we've come a long way in how we pull information from the accounting system. But the basic accounting system of tracking the resources that go into your business, tracking how your business uses those resources, and tracking how those resources are consumed or applied in your business have not changed in over 7,000 years. So what we're using now works. It worked for your parents, it worked for your great-great-great-grandparents, and it worked for the pharaohs and kings for the last 7,000 years. So what do you use to manage your business? Well, think about it. Are your business reports compiled manually or automatically? Do you use a bunch of spreadsheets? Do you use a bunch of pieces of paper? Do you just look at invoices that are stacked high on your desk? Are your business reports accurate? And again, are they timely? And are they consistent? Do they show you the same numbers in the same place on the same reports each month? Now, the numbers are going to change every month, depending on whether your sales go up or down. So, and that's okay. Your numbers should change every month, but the numbers in context and numbers compared to the same types of numbers from previous periods should be somewhat consistent. If you're on an upward growth path and they're continuing to increase, If you're on a spiral downward, then they're going to continue to decrease. And if you're on a downward spiral, it's very difficult to actually change that downward trend and then turn it around to grow your business back. So if you're on a growth path, you want to stay on a growth path. If you see your growth slow down, it's more important to reverse a declining growth trend than it is to reverse a downward spiral. Because once you're in a downward spiral, it takes more than twice as much effort to reverse the spiral and turn it into a growth trend. So if you can reverse a declining growth spurt, you're much better off. It takes less effort, less time, and you're more successful throughout the entire month. All right, what do you want to track in your accounting system? Probably you want to track profits, and you may want to track profits per sale. You may want to know who are your 10 most profitable customers and who are your 10 least profitable customers. Chances are, when you look at your 10 most profitable customers, they're the ones that are also providing you with referrals from their friends and neighbors. They like what you are offering. They like the price that you're charging. They like the delivery terms that you have. They like a lot of things about the way you do business, and they're happy to share their experiences with other people that they know so that other people can receive the same value that they're receiving from your business. If you look at the 10 least profitable customers, they're probably the ones that complain all the time. They're never happy with your prices. They're never happy with the way the products are delivered. They're never happy with the range of colors and sizes that you have. They're just generally, as a trend, they generally are the most unhappy people that you have to deal with. And if they're least profitable and they cause you the most headaches, why do you still have them as customers? That's a management decision. I'm not going to tell you that you should get rid of them, but I will tell you that some consultants will tell you if you're always getting rid of your 10 least profitable customers, your company is going to be more profitable in the long run. I'm not going to touch on that because I think it's a personal decision. There's a lot of things that go into that statement in order to make it true. You can look at your profit versus cash in bank. A lot of new entrepreneurs think that the cash in the bank equals their profit. And that is never true. That is never true, because there's a lot of things that happens to your cash once you collect it from the customers before it goes into the bank. For one thing, you may make a sale and you may not collect that cash, excuse me, until the next period. So cash in bank will be lower that month than your sales are or than your profits are. And so that's a reconciling item. You may take money out of the business, so you have less cash than your profits show. So that's a reconciling item. You may pay off a loan. You may make loan payments. Paying off a loan is not an expense because when you got the loan proceeds, that wasn't income. You didn't pay income tax on loan proceeds when you made a loan from a bank. So therefore, you don't get an expense for paying back the loan. You do get an expense for paying back loan interest because that's more than the loan that you paid, that you received. So you can write off loan interest, but not the loan principal. So there's a lot of items that go into reconciling your profits to your cash in bank. And that is the role of the statement of cash flows, which we'll touch on a little bit later. You may want to look at customer loyalty. So you're going to look at your sales frequency to customers. When was the last time they bought from you? How much did they buy? Are they buying the same amount? Are they buying more or less? Is it a recurring customer? Now, when I say recurring customer, for some companies, that's every week, like a grocery store. For some companies, it's once a month, like a janitorial service. For some company, it's once a quarter or maybe once a year, like a tax preparation business. That's once a year. But as a CPA, I can tell you that I have customers that have been with me for 30 years and they come back every year. I only see them once a year unless there's some issue that comes up in their life that they need more advice during a year, but I may only see them once a year. But they're a recurring customer for me, even though they're only once a year. And do you have a niche? Do you have a special place in the marketplace? And are you serving a specific group of people better than anybody else? If you have a niche and if you have a loyal customer base, then chances are they're buying from you for a reason other than low cost. Okay? Low cost is the least profitable way for you to design your business, and your accounting systems can help you identify if you have minimal profits because you have minimal prices. Are you efficient in the use of your payroll? How's your staff performing? What is your staff turnover? How many times do you have to hire people for the same position? Are you abusing your overtime? Overtime is important on an exceptional basis, but if you're using overtime on the same employees on a recurring basis, then maybe it's time to look at hiring more staff and paying them straight time instead of paying overtime, which is a premium pay expense. So let's talk about an ugly truth about accounting. If your accounting system cannot support your financial information needs, then you're spending too much for the program. Now, there are some solutions to that. Sometimes you need to buy a more expensive system that offers better reports. I can't tell you how many times I've seen a customer go from something like QuickBooks, which I know we're going to touch on a little bit, to something that costs $5,000 to $10,000 to $50,000 for an accounting system, because it offers better reports. It helps them manage their business. It helps them grow their business. It helps them buy on a discount. It helps them buy only what they need for sales in the next period. And so they have economies of scale. Sometimes you can purchase enhancements for your current system. So the current system isn't giving you what you want, but for a few extra dollars, you can buy some apps for your current system. And sometimes you need to hire or build stronger skills for your organization. Sometimes it's just that you don't have the people in place giving you the information you need from the accounting reports. Again, this is not a course on turning you into a bookkeeper. That's not your role in the business. But if you're going to delegate your accounting recording procedures, you need to make sure that the people that are doing that have the skills that they need to talk to you about exceptions that occur as they're recording in your system. Or you need to have somebody who's there looking at the reports to give you some feedback on exceptions. So a lot of times companies will hire a bookkeeper to record the daily operations into the accounting system, record the daily invoices, record the daily bills from the vendors, cut checks, process payroll, etc. And then they'll hire someone with more advanced skills to come in once a month or once a quarter to look at the financial statements and give the owner an assessment to analyze what's going on with the business and give the owner feedback about what the owner can do to improve the profitability of the business. And the problem with many entrepreneurs is that they say, well, I already bought an accounting system. It's supposed to work for me. So why should I invest in more of my profits into a system I already have? So the ugly truth is that all of these solutions can provide significant benefits, but each one has a cost. And if you're not willing to invest in your business, it means you're not willing to get the best business productivity that you can. Running a business does cost money, and you have to understand when is the time to spend money and when is the time to invest money and when is the time to keep your money. So how much does it cost to have an accounting program? I will tell you that currently QuickBooks costs you about $90 a month. So that's a little over $1,000 a year. There are other programs in that same cost range. And I will tell you that all of the accounting programs do basic accounting well. What really matters is whether or not the accounting system provides you with the reporting that you need to make decisions going forward in your business. I tell you, there are accounting systems out there that cost $50,000 or more. I worked with a county in another state, and they spent over $1 million on their accounting system. Now, it's true, it did things other than basic accounting. In fact, it did a lot more than basic accounting, but it did do basic accounting, and they spent $1 million on it. And that was considered a good buy. I used to sell accounting software that now goes for $50,000 each for each customer. And then on an annual basis, those customers pay in excess of $20,000 for maintenance. So accounting programs cost money across the board. The most common accounting software that we see among new entrepreneurs or small businesses is QuickBooks. And right now, the price, there are multiple price points for it. And I will tell you that the price points for the programs that are less than $90 will do everything that they say it will do, but it really is not the product that you need for a growing company, for a company that's expanding and growing. There's a simple start, there's a basic, and then there's the QuickBooks Online. And I usually recommend to customers who have a commitment for a full-time business, that they want to see the business grow, they want to see it as profitable as it can be. If you're going to use QuickBooks as your accounting software, to get the traditional program, which right now is about $90 a month. It will do all of your basic accounting. It will create many of the enhanced reports that we're talking about in this program. And they do have access to an entire catalog of add-on programs. Everything from connecting your point of sale to QuickBooks, to running a apartment complex with the automatic billing on a monthly basis. They have many different programs. They have an actual point of sale that you can connect to a cash register, which connects to QuickBooks. So they have many add-ons to the program, to the basic program. So there's the initial purchase price, there's any add-on costs, there's upgrades and maintenance. Even QuickBooks has an ongoing cost. There are multiple versions from the same publisher, so you need to know which version is going to work for you. And there are industry-specific software programs out there as well that will cost probably more than $1,000 a year. So if your accounting records hold more, so it's a basic statement that your accounting records hold more information about your business than any other single source of data. I know that some companies have elaborate contact management software. They call it CRMs or sales databases. Some companies have elaborate warehouse systems that connect to vendors and create catalogs for all their products. So there's a lot of different software available to companies to run their business, but the accounting software that you have is probably going to have more information about your business than any other single source of business. And so some of the things that it has a customer list, a product catalog, year-to-date profit, the book value of your assets, your inventory status. As you can see from this slide, it has a lot of information about your business. So some of the key things that you want to look for in your financial statements are the three statements: are the balance sheet, the income statement, and the cash flows. So from these three statements, the balance sheet shows items with long-term value. So anything that costs more than $2,500, and that's kind of a key for taxes. So if it costs more than $2,500 and it lasts more than a year, it's an asset. It is not an expense. Now, some people get a little confused because they know that for any item that's an expense, that's a tax deduction on their income tax return for the business. Assets can be deducted in the first year of the purchase if it meets certain criteria. There are depreciation rules, there are bonus depreciation rules, and there's what's called the Section 179. And each of these three items allow you to deduct a certain portion of your assets, of your asset value in the first year that you purchase it. But if it is not recorded as an asset correctly, and you record it as an expense, from many entrepreneurs' perspective, a deduction is a deduction. What does it matter if it's an expense or a Section 179? But from the IRS's perspective, it does matter. And your tax preparer knows the difference. If the tax preparer does not know the difference, run and hide from that person, because that is a basic tenet for all business tax preparation preparers. So you have to know how to classify all of your transactions correctly when preparing your accounting statements, and also when you're preparing your tax returns. So the balance sheet shows you what are your assets, what are the things that you have that has long-term value, that has a significant cost, and what was the source that was used to allow you to acquire those assets. Was it a loan or a liability, which is called external funding? Was it your initial investment, or the profits that you reinvested? Profits that are reinvested in the business are called retained earnings. Or was it revenue? You generated revenue from sales. Did you turn some of that revenue into cash, which you then use to buy assets? So the balance sheet will show you some of those things. It shows you what do you have, own, what did you invest, your equity, and what did you acquire from other resources at your liabilities. Excuse me. The income statement, by contrast, which is a totally different statement, measures your ability to sell items above cost, and it also shows you how you manage expenses without consuming all the profits. So it's a measure of your ability to manage your business. That's why to manage your operations, not to manage your investments, because assets are things that you invest in. Your operations are things that allow you to generate revenue, and it also requires that you spend money in expenses. Okay. And the third statement is a statement of cash flows. And that is your reconciliation between your net profit and the cash in the banks. It tells you what happened to the amount of profit that you generated before it went into the bank, and it tells you what was left that went into your bank at the end of the month. So the statement of cash flows is generated after you reconcile your bank account to your accounting records. And it is a reconciliation between the profit and the cash in the banks. So here's an example of a balance sheet. You can see typically assets are shown on the left-hand side, and both the liabilities and the equity is shown on the right-hand side. And a couple of things to look at on a balance sheet. Notice that the total amount of the assets, in this case, $450,000, has to equal the combination of liabilities plus equity. So you see total liabilities of $300,000, total equity is almost $150,000. That's where you get the total of $450,000. That number has to be equal to the total assets. So the balance sheet has to balance, whereby the assets equal the combination of liabilities and equity. It has to balance. Even on the tax return, it has to balance. Okay? If it doesn't balance, your balance sheet lacks integrity. There's some problem, and you should correct it immediately before the next month continues. Now, the income statement, on the other hand, shows your revenues, shows three major portions, three major pictures of your business. Shows the revenue, which are the sales that you generate, minus any returns and allowances that you offer to your customers. It shows the cost of the goods that you sold. And cost of goods sold, the definition of cost of goods sold is the cost that you incur in order to deliver your products and services to the marketplace. Okay, so it includes the cost of the inventory that's sold, not the cost of the inventory that you purchased that month. It's the cost of the inventory that you sold that month. So these purchases, this $80,000 in purchases right here, relates only to the sales of the $200,000 for the same period when you're using accrual basis of accounting. If you're using a cash basis of accounting, this may or may not connect. And that's why I do not recommend to my clients that they use a cash basis of accounting. I recommend that they use accrual basis of accounting, because that means the cost of goods sold will relate to the revenue. Now, let me back up a step, go back to the balance sheet, and you can see that inventory is on the balance sheet. This is where inventory is recorded when you buy the inventory from the suppliers. So when you buy inventory from a supplier, it's an investment, it's an asset, and it doesn't hit the income statement until you sell it. So it's not an expense. A lot of people get confused about that. If I buy inventory, that should be an expense. I should get a tax deduction. No, not under accrual basis of accounting. You record the inventory when you purchase it on the balance sheet. And then if you have an automated accounting system that is set up correctly, when you make a sale, when you generate an invoice to a customer, the cost, not the price, the cost of that inventory is removed by from the balance sheet automatically and placed on the income statement into this purchases account, or whatever it is that you call it in your accounting system. A lot of people call it a COGS, a cost of goods sold, which is kind of not a good label, because this whole section is called cost of goods sold. You can see the cost of goods sold also includes any packaging costs that you had for those items that were delivered, any freight, any local delivery, any commissions that you paid to salesmen for generating this month's revenue. Now, the interesting thing about your cost of goods sold is that unless you have a major change in inventory or in inventory pricing, the percentage of cost of goods sold to revenue. So if you take the cost of goods sold, which is 103,000, and you divide it by the net sales, which is 199,000, whatever that percentage is, that should be the percentage that you're looking at month after month after month. It should be a very consistent, not exactly the same, but it should be a very consistent percentage every month. Okay. So that means that your gross profit as a percentage of sales, so this 95,000 divided by the 199,000 should be a consistent percentage month after month. So this is an important number. It's an important number for break-even analysis. It's an important number for when you're analyzing whether or not your profits are getting compressed because your costs are going up, or because you've lost your discounts because your sales have dropped and you can't buy as much of your inventory to qualify for discounts on the purchases. So that's a very important number to look at, the percentage of the gross profit compared to net sales, to make sure that it's consistent month after month. The other thing is that when you look at gross profit as a number, you're looking at the premium that your customers pay you because of the combination of goods and services that you provide to your customers. The higher the gross profit for any level of sales, the higher your customers tend to value your business and your products. And when you have a high gross profit, your customers tend to provide greater loyalty to your customer, not less. New entrepreneurs think that if I offer low prices, I'll get more sales and customers will be more loyal. That's not necessarily true. And the point, the thing that I point to all the time is the Mercedes-Benz. Do you think the gross profit of Mercedes-Benz is minimal? I can promise you that it's not. Gail Benson is doing very, very well in selling those Mercedes-Benz cars. And there's a premium on what you pay to own one of those cars. Now, the third section is the overhead. And this is the cost of running your business every day. So if you want to know what it costs you to open your doors every day, you take your total overhead for the prior month divided by 30 or 31, whichever number you want, as long as you're consistent. And that's your cost, your daily cost of running your business without regard to $1 of sales. So this is the cost, the overhead is the cost of running your business. The cost of goods sold is the cost of selling your products. And the sales, obviously, is the revenue that you generate from interacting with your customers. And the bottom number here, the net income, that is a calculated number. That is not a number that appears in your accounting system. It's only a number that appears on your accounting reports. Okay, so it's a generated number. And I will tell you that at the end of the period, the income statement reverts back to zero and it restarts at the end of at the beginning of the next period. So you can track what your profitability is on a monthly basis or on an annual basis or whatever other period you're looking at. So whatever number this is at the end of the period, it goes to zero. And that number gets shifted. I'm going to go back up to the balance sheet again. It gets shifted into this account called retained earnings. Okay, so retained earnings, on QuickBooks during the year, you'll see that it comes into the current net income line. QuickBooks makes that distinction, so they'll keep this line available until the end of the year. When you look at this balance sheet at December 31, you'll see a current net income line. If you look at the balance sheet the next day on January 1, the current net income line is zero, or it disappears. And the amount that's on that line is shifted and added to the retained earnings account. So these two accounts are combined on January 1, or it's combined on the beginning of, well, I'll say on January 1. QuickBooks does that at the end of the year. The other thing is that, and you don't see it on here, there are no negative numbers on here. The only negative number that you want to see is called accumulated depreciation. And I don't think we're going to have enough time to go into depreciation concepts in this session. But if you have any other negative numbers on the balance sheet, that doesn't mean your balance sheet is incorrect or it's wrong. It just means that you have some work to do to stabilize your business. There shouldn't be any other numbers other than the accumulated depreciation that show up as negative numbers, except the only other number that may show up on your balance sheet during a year is owner's draw. So the owners are allowed to take out their equity anytime during the year without any income tax implications, okay? So you don't get taxed on any equity that you withdraw from your business throughout the year. You can take as much equity out of the business as you want, but if you take it all out, it makes your business unstable financially, so you can't afford inventory for the next year, you can't afford new equipment, because if you've taken equity out, you've taken an equivalent amount of cash out. Because remember, this right side has to balance the left side. So if you're taking equity out of the left side, you're probably taking cash out of the right side so that the totals will balance. So you might see a negative account for owner's draw, and you'll see the owner's draw account, and instead of just reducing retained earnings, you'll see an owner's draw account so that you can identify how much money you've taken out of the business as the owner, how much money you've taken out of your equity as the owner. And that does have an income tax implication, but it doesn't cost you income tax liability. You don't have to pay tax on the amount that you take out of your own equity. And the reason you don't have to pay tax on removing your equity is that you're going to pay tax on your business personally when you have profit at the end of the year. You're going to pay tax on the profit that the company has generated. Now, unless you're a C corporation, which most entrepreneurs are not, you might be an LLC filing as an S corp, you might be an LLC filing as a Schedule C, or you might be a partnership. And the profit is going to be assigned to you as the owner at the end of the year, and that's the amount of that you're going to pay income tax on. Whatever the profit is, you apply your tax rate to that, and that's the amount of tax that you have to pay. So you're paying tax when your company earns profit each year. So if you reinvest that profit, you shouldn't have to pay tax on that again, unless you're a C corp. There's different rules for a C corp, and there's very few reasons why a small company would be a C corp. And so the retained earnings account becomes very important, because if you reinvest your profits, then you can keep track of the money that you're allowed to take in future years when you have an excessive amount of cash and you don't want to keep that in the business, you want to take that. Or when you do need money other than taking a salary from the business, if you do need additional money from the business because it can afford it, then you want to know how much of that equity you can take out without paying tax. And so that retained earnings account becomes very important as a record keeping account, as an accounting line, as a tax implication line, so you don't pay tax on that again. All right, and the statement of cash flows, we kind of touched on it. It's a reconciliation between the net income and the ending cash or the cash in the bank account. And so we start with the net income. We look at any cash that was generated by the operations, and that's cash generated by the operations can be from collecting on your accounts receivable. So when you send an invoice to a customer, that's you're going to recognize the sale, and that goes into generating a profit, but you may not collect on that invoice until the next period. You make a sale on June the 28th, you may not collect it until July. That's into the next period when you collect on that invoice. So you have an accounts receivable in June for June period, and then you may collect on that accounts receivable in July. So when you collect on your accounts receivable, you're generating cash on the cash flow statement. You can also generate cash from investing activities. Some companies actually have stocks that are owned by the company, and those stocks, you might buy it, and maybe you paid $100 for the stock, and the stock market went up, and now that stock is worth $600, and you decide to sell it. So now you have a $500 profit from that's an investing activity. You might have cash from financing activities. Financing activities are when you get a loan, or you use a line of credit, or you use a credit card and you haven't paid for it yet. So now that you get the cash from the loan, now you're going to owe that cash back at some point in the future. But it can be a source of cash inflows. Once you start paying the loan, it's a source of cash outflows. So you take all of that, all of those changes, you add it to your beginning cash in the records, in the accounting software, and you reconcile the bank statement to get the ending cash. So the statement of cash flows does this for you automatically. QuickBooks will generate a statement of cash flow automatically. It's one of its reports, but you have to have completed the bank reconciliation process before you generate this statement in order for it to be accurate. But it does tell you what happened to your cash as to the reason why the cash in the bank is different from your net profit. So it does answer that question. Remember that we've used the same accounting rules for over 7,000 years. And so we're using a concept called double entry accounting. Now, when you use QuickBooks, most of the time, you are shielded from seeing this double entry in recording your accounting transactions. You're only going to record one side. So when you write a check, you don't realize that recording a decrease in cash is one side, because all you're recording is what was the expense account that the check was used for. So you're only recording the expense account on when you generated a check. You're not recording the diminished cash amount because QuickBooks does it automatically. Just like when you generate an invoice, you're automatically increasing your sales, but you're recording an invoice to a customer. So what you're recording is what they purchased. All you have to enter on the invoice is the items that the customer purchased. And maybe you record the price. Maybe the price is automatically set within QuickBooks and you use the default price. So although QuickBooks is generating both the sale and the purchase, remember it transferred inventory from the balance sheet to the cost of goods sold section, and then it's calculating the profit. It's doing all that in the background. So it is following the system of double entry accounting, but in most cases, the automated accounting programs shield that from you, and you're only recognizing that you're recording one side of the transaction, which is kind of nice. Kind of nice for the owners and people who are operating the business. So what are some of the things that you should be doing every month to keep up with your business? Well, you should reconcile the bank statements every month. And when you're reconciling the bank statements, you should verify the signature on the checks, on the canceled checks. You should verify that the payee was an authorized payee. So if you have somebody that a check was written to that you don't recognize, you should investigate a little bit further. And you should verify on your payroll reports that all of the employees are active employees, that you don't have any phantom employees that are receiving payroll checks. So paying a payee that you don't recognize or paying a phantom employee are two key ways that people can use to steal money from your business. When you are looking at segregating your processes, you want to make sure that the employee who is reconciling the bank account is not the employee who is recording the checks in the accounting system. If you only have one bookkeeper, then you might delegate that to an outside accountant who will come in once a month and reconcile your bank, as well as meet with you to talk about any exceptions or any additional analysis about your business. You should compare your sales to your budget amount. If you don't have a budget for your business, do one. If you don't know how to create a budget, because you say, well, I don't know what's going to happen next year. I don't know how to calculate it. I don't know how to forecast it. What a perfect time to bring in an expert consultant to help you develop those skills so that you can learn how to do that on your own going forward. Give a man a fish and feed him for a day. Teach a man to fish, and he's fed for the rest of his life. Same thing with a transfer of skills. If you hire somebody to transfer their business skills to you, you become a much better business owner, and you can expand the amount of profits that you can generate for the rest of your life. You should verify your gross profit margin for consistency on a monthly basis. And you should compare your overhead to your budgeted amount. Again, going back to the budget. Should be doing that every month. You should look at the statement of cash flows and make sure you understand the concepts that are in there. Once you review that with someone who understands how to read it, you'll learn how to read it yourself. And then going forward, it'll make a lot more sense to you. And it'll be very meaningful, both as a control report for internal controls and also help you assess your business operations. You should look at your inventory turnover. How many times is your inventory turnover every quarter, every year, every month? Is it increasing or decreasing? Sometimes you have to segment your inventory into the high value items and the low value items, or the high profitability items versus the low profitability items. Low profitability items should be turning much faster than the high value inventory items. If you look at a jewelry store, the very large diamonds do not sell every month, but the very small rings and earrings, the things that hover around $100, turn over very quickly, multiple times every month. And that's just the way people buy. People buy lower priced items more quickly, more often than they buy higher priced items. You should look at your accounts receivable collections as a turnover amount. And if you work with your accountant to understand how that's calculated, you can calculate that every month. And you should manage your accounts payable and take advantage of early payment discounts that are offered by the vendors, because that's free profit that you're passing up if you don't take advantage of that. And if you're not managing your accounts payable, not because of a cash flow shortage, but because you just didn't have time to get around to doing it. You should look at your credit card balance and make sure that you're comfortable that that's a reasonable balance at the end of the month. You should look at your loan balance and make sure that it's decreasing every month. Every time you make a payment, unless it's a line of credit, your loan balance should be decreasing. If it's not, there's an error in how it was recorded. You should look at your payroll cost and make sure that you're not abusing the overtime charges, because overtime is a premium expense that if you're incurring that every month, maybe it's time to increase the number of people you have on staff. So some of the more common mistakes that we see in accounting is that the loan payment, when you make a loan payment, even though you're writing a single check to a bank or whatever financial institution you borrowed from, even though you're writing a single check for the monthly payment, that check should be split into two accounts. The principal should be applied against the loan account on the balance sheet to reduce the loan balance. And the interest portion of that check should be recorded to interest expense so that you can take a tax-deductible expense for the interest that you paid on that payment, on that monthly payment to reduce the loan, okay? So every month you should have two accounts listed on your check stub for that payment. I've seen errors where 100% of the check was written to interest expense, and I've also seen errors where 100% of the check was written to loan balance. And so when you write 100% to the loan balance, you're not taking advantage of the tax expense for the interest portion of it. When 100% is written to interest expense, that's an error. And if you're audited by the IRS, two things will happen. They'll recognize that the loan balance doesn't change, and also that you've overcharged your expenses. So you've unreported your tax liability, and they will charge you a catch-up amount for the tax, the late payment penalty, and the interest associated with that late payment. Depreciation is a recognition of an asset that you've purchased and the amount that you've used of that asset during that period. So when you buy an asset, let's say you buy an asset for $10,000, and let's say that the IRS says that that asset should last you 5 years. Well, every year you can record an expense against that asset of 20%, 1/5, because it was a 5-year asset. So if it's a $10,000 purchase, then every year you can write off $2,000 of that equipment. It's a $2,000 expense each year. And then on your balance sheet, you'll see the accumulated depreciation account, which is a negative account. That starts off in the first year with $2,000. The next year, it goes up to minus $4,000. The next year, it goes up to minus $6,000. So that in any year, you can see how much of that asset you've used up according to your tax return, and how much you have left for a book value for that asset. And that's an important number for your taxes. And your tax preparer can help you figure out what your depreciation expense should be for all of the assets on your balance sheet. Cash, looking at a bank statement is looking at the balance in your bank account. An online balance is not a control activity, but reconciling your bank statement is a control activity to identify frauds and errors. And believe me, banks do make errors on your bank account. Just putting an additional zero will result in the bank charging you a whole lot of dollars more than what you expected. But banks do make mistakes on a regular basis, but it's not a frequent basis. So it's important that you reconcile your bank statement on a monthly basis. And looking at your statement of cash flows, once you understand how to read it, is considered an internal control function. It helps you identify errors that were recorded in your accounting records to hide theft and fraud. So some exceptions when you're looking at a balance sheet, the only negative number should be that accumulated depreciation or possibly an owner's draw during the year, throughout the year, not at the end of the year, because at the end of the year, the owner's draw is compressed with the account, with the retained earnings. So at the beginning of the year, your owner's draw goes down to zero, just like the net profit line in QuickBooks goes down to zero. But QuickBooks doesn't do that automatically. You'd have to do that with a journal entry. Accounts receivable should not increase without a sales increase. So if you look at your accounts receivable balance on your balance sheet and it's increasing every month, but your sales level for that month has not increased, there's a problem. That means that you're not collecting on your accounts receivable. And so you're losing money because you're making loans to your customers and you're not charging them interest. So you're losing money. Similarly with accounts payable, it shouldn't increase unless you have a change in inventory policy, because the things that you buy from your vendors are pretty consistent month after month, except for inventory. Inventory can change throughout the month as your seasons, as your buying seasons for your inventory changes. So make sure that your changes in the accounts payable balance are consistent with a change in inventory policy. The loan balance should decline every month, and retained earnings should only change by the amount of profit minus owner's draw. Unless you're using something like QuickBooks, which will show you those three things: retained earnings and current profit and owner's draw separately throughout the year. On the income statement, some of the exceptions are that sales increases should match budget forecasts. If not, if you have a significant rise in sales on a sustained basis, that's called hyper sales, hyper growth, and that can soon become unmanageable, because when you're selling way more than you anticipated, you don't have the inventory, you don't have the cash to support buying new inventory, your accounts receivable grows, and your collection procedures have to be consistent with the new higher accounts receivable balance, and things can just spiral out of control until you're left with no money and all these promises of great sales. Your gross margin should be consistent each month as a percentage. So look at that. Otherwise, your profits are probably becoming compressed. Gross profit should trend with the sales. So if your sales are going up, your gross profit amount, not the percentage, but the amount should increase. Overhead should be consistent from month to month to month. I mean, your rent doesn't change month to month. Once you have an insurance policy, if you're paying it monthly, and that's not going to change until the policy changes at the end of the year. Your utilities may change a little bit, and your payroll should not change unless you're paying overtime. Then your overtime should be listed as a separate line item so that you can monitor that separately. And then book versus tax. And this is where we get into the nitty-gritty for taxes. There are many reasons why the financial statements are going to be different than the business tax returns. But whoever is preparing your tax return should provide you with the reconciliation when they present you with the completed tax return package. If you don't have that reconciliation, if you don't know why there's a difference, you will probably lose money in an IRS audit, because the IRS agent is not going to help you determine the difference. They're going to say there's a difference here, and so your books show higher income than your books show lower income than your return. So we're going with the return amount, so therefore you owe more money. So you want to know what the difference is, and you want to have that reconciliation that you keep with the tax return. And you should keep your tax return. I will tell you, the IRS says you need to keep your tax return for 3 years. I'm going to tell you, you should keep it for 7 years, or for as long as you own the underlying assets. So if you have tax records for a vehicle, or for forklifts, or for those kinds of equipment, you should keep those purchase records for as long as you own the equipment. Tax returns you should keep for 7 years. All the underlying original invoices you should keep for 7 years, or for as long as you own the underlying assets. When you're looking at your business, and this is important because this helps you when you're preparing your budgets. It helps you when you're building the infrastructure of your business. And it helps you when you start looking at the types of information you want to pull from your accounting system, because that changes with the stage of your business. So when you start your business, you're in startup. And that's when you're trying to figure out, what are your policies? What are your procedures? What are you going to do? Who you're going to sell to? What is your market? What is your niche? In your startup, you're figuring out the rules of the road. The next stage is stability. And this is where you start to have recurring customers coming back to you, buying again and again. So it's going to take you a few months to move from startup to stability. You don't do that in 1 month. You want to know that you have a strong customer base that you can draw upon and that you have something to build upon. The next stage is growth, and that's where you have all your policies and procedures in place. You probably have a procedures manual. You have some sort of training process that you go through for new employees. You probably added some new employees. And you're moving into the growth phase. So now you're building on the base of customers and the market that you've identified, and you're going deeper into that market to get more sales and therefore more profits. And the next stage is maturity. And that's for a company that's been growing, and now they've had a long-standing position in the marketplace. So maturity is reached after multiple years, maybe multiple decades. And you're at a place with your growth, with your success, and you don't have to change a lot of things. You just have to make sure that sales are not diminishing. And I have to tell you that you're always looking for new customers. You're always looking for new customers because customers will roll off of your books naturally. People leave, they retire, they get tired of your products, and they move on to buying products from other people, not because of anything you've done, not because of anything that your customers dislike about you. They've just moved on. And so you have to always replace those customers just to stay in one place. So you always have to be looking, you always have to look for new customers. You also always have to have a process in place to seek out new customers just to remain stable. So in a maturity phase, that's what you're doing. You're trying to stay stable by having the same amount of sales on an ongoing basis. But you do still have to have a process to bring on new customers to replace the ones that have rolled off. And then the last phase that some companies never ever achieve, because they stay in maturity until the owner retires, and then the company is either sold or the company closes down because the owner wants to retire. And by retire, that doesn't mean that the owner aged out; it just means that the owner wanted to move on to something else. But in revitalization, the company is reinvigorated. They bring on new products. They have a transition to the next generation or to a new set of owners. So the original founders will now start taking on new partners, or maybe they'll do an employee share program where the employees become part owners, and then employees eventually become all of the owners, and they buy out the founders. And in the revitalization, you look at new ways to do things. You bring on new automation. So you automate your warehouse. We're looking at now self-driving delivery vehicles and drones to deliver your products. So you start looking at new technology and how can you bring on new ways to reduce your costs and improve your profit? How do you bring on new products? How do you introduce to your customers the same value that you've always provided in a new way, in a new and innovative way? iPhone did that. They took the cell phone, which was an extension of a beeper. A lot of people don't even know what a beeper is anymore. They took a cell phone and they turned it into a smartphone, and then they've been enhancing it every year. So Apple is a company that, if you look at their history, they have revitalized the company multiple times. When we look at this slide, this is the growth model. And this shows you how the cost of companies change over time. And this is an important concept to know, because the cost of your company as you grow your business is going to grow significantly over time. And typically, in order to grow from one phase to the next, you're going to need outside funding. And the outside funding is really important for tax purposes and also for your business operations, in order to take you to the next level. Once you have funding from outside your business, the funding is either going to come from additional equity from outside investors, like partners, or it's going to come from joint ventures, which that has its own tax implications, because now you have to keep track of your sales and your joint venture partner has to keep track of their sales. Or you're going to have loans from banks and you need to keep track of the repayment of the principal separate from the repayment of the interest. So when you first start your business, you probably started with some sales. And that's why you see that the diagonal line starts above the origin point where the vertical and the horizontal lines meet. So the horizontal line is time, the vertical line is increasing revenue in dollars. So you started off your business with some amount of sales. And so we start with the vertical line. Now, sales are not going to increase on a vertical line. So this is a conceptual statement here. And so over time, your sales are going to grow because you're going to get better at selling to a market who appreciates your business. If you don't get better at selling, you're probably going to go out of business, okay? And many businesses fail within the first 3 years of their history. So if your business fails, sometimes it's because you opened with a product that was not requested in the marketplace, so you opened in the wrong place. You opened at a wrong time. There were companies that tried to start during the pandemic, and for many of those companies, they were opened at the wrong time. Or you opened at a time during an economic downturn. We're in a recession now. The government won't admit that we're in a recession, but by all definitions that have been used for the past 50 years, we're in a recession. And this is a tough time to start a new business because we're in a down economic term, a down economic cycle. And so when your business is starting, you're in that initial phase, that startup phase, where you're trying to figure out what kind of business you're in, what your policies and your procedures are. What are you going to do when somebody wants to return things? What are you going to do? How are you going to train your first employee, your next manager? How are you going to stop from working 7 days a week and shift to a 5-day a week and still stay open 6 days a week? So you're figuring all those things out in the startup. And so your overhead when you started was at a certain level. And that's the first horizontal line above the timeline. That is the amount that you had to spend in overhead costs to keep your business open. And so you're going to go along and you're going to start growing your business because you're going to start figuring out all these things and you're going to get more efficient and you're going to continue to market to your customers. So you're going to get more customers coming in as they learn about the value of your business. And so your sales are going to grow. And you're going to stretch your capacity. You're going to start off with excess capacity. So this diagonal line starts off below the startup overhead line. So that tells you that you had a lot of excess capacity in your overhead. You had more space than you needed. You had room in your warehouse or your back storage to hold more inventory than you can afford. So you started off putting all your inventory out on the floor, but you had some additional space. So you kind of spread it out so you had a lot of room. And then as you got busier, as you got more successful, you bought more and more revenue. So you started to consume some of this excess overhead. When you get to the point where that first line, you see the arrow in the first line above the timeline meets the diagonal line. Right at this point here, that is where you are most efficient for this level of overhead. That is where you have the maximum profitability for this level of overhead. But if you continue to grow, you're going to stretch your use of the resources till you get to this first gray circle. This is the point at which you have stretched your use of the overhead that you started with. This was the overhead that you started with. And you've stretched your capacity so that you now have more inventory than you can handle on your floor. you have staff, you're using overtime because you don't think you're ready to hire that additional person full time because you don't know if your growth is going to continue. So you have stretched as far as you can. And so if you go beyond this gray circle here, you're starting to lose profit. Even though you're growing your business, you're starting to lose profit because you're starting to make mistakes. You're starting to have to buy inventory that you can't afford. So now you have to borrow money to buy inventory. So that's costing you more money. So you're actually losing profits until you stretch and actually change your overhead to this next level. So you may be moving to a new place. You may be now starting to use a warehouse so that you can buy inventory at a discount. So you don't have to buy the emergency supplies of inventory. You're buying larger amounts of inventory. You've negotiated a line of credit at a reasonable interest rate so that you can afford this new inventory. Instead of using overtime, you've now hired additional staff. So now your total overhead costs are at this next level. And this is a stability level. So when you grow from this first gray circle up to the next arrow point along your revenue line, you're once again at your maximum efficiency for this level of overhead. So you see that your costs now have increased permanently to this level. And even though at this gray circle, you have excess capacity that you could grow into until you reached your maximum efficiency point, you can still go beyond that in your growth cycle until you get to the next gray circle. And it's at this point that you've stretched your next level of overhead to its maximum profitable level. When you go beyond that, you need to move your overhead amounts, your overhead investment to this next level. You can see that this vertical line is the difference between your overhead costs at this level and your overhead costs at this level of your business growth cycle. And you can see that this vertical line is a much bigger jump than this first vertical line. So your investment to move from startup to stability is much lower than your investment to move from stability to the growth phase. And that's why you need external financing, because your profits are probably not going to be large enough. Your reinvested profits are probably not going to be large enough to help you afford this new growth stage. You'll have to get external financing in order to grow, in order to afford moving to this next overhead level. And then the next overhead level would be the maturity stage, which is up here, which again is larger than the initial move, but not quite as large as moving from stability to growth. And that tends to be a truism for many businesses. It may not be exactly the same for your business, but as a concept, you can see that you need to manage your business at all levels. You need to know when you're at this gray circle for your level of overhead so that you won't have diminished profits from growing your business. Okay, so it's very important that you know how to read your financial statements to recognize when you're at that point. We have some more time, so I do have some more material that I can go into regarding your accounting system. Keep in mind that businesses, for every growing business, there's three things that owners need to do. They need to take care of marketing and sales. They need to take care of their operations, and they need to take care of their administration. Things like renewing insurance policies, or paying their payroll tax, or paying their city occupancy tax. That's all the administration. Operations is doing the thing that you do, whether that's warehouse operations, selling on a retail floor, manufacturing products in your manufacturing facility. Operations are the things that you do. Marketing and sales are all of the activities that go into actually selling to your marketplace, attracting the customers, making sure that they're satisfied with the purchases, making sure that they know about any new changes in your business. That's all marketing activities. And then the actual sales activities to transfer ownership of your inventory to your customers in exchange for cash. So every growing company has to take care of these three things. And each of these three major areas of your business requires a different kind of personality. The people who do well in marketing and sales are people who like a very dynamic environment, things that are changing all the time, things that are always a new challenge. They get bored easily doing the same thing over and over and over again. Whereas people in administration really enjoy the consistency of the weekly cycle. They know that every Thursday time has to be turned in so they can get payroll out on Friday. They know that every Tuesday they're going to have to reorder inventory. So they're waiting for those inventory reports from the warehouse to come in so they know how much to reorder from the vendors. They know, so they're on the same cycle every week, every month, every quarter, and they can schedule that in their calendars. So they know what their workload is every day. In operations, we see that the personalities that shine in the operations will either be more like sales and marketing or more like administration. So if you're a manufacturer, the people are going to be very satisfied with things that are consistent. They come in, they work the line, they know how many products they need to make every hour, every day. They know what it takes to maintain the equipment, so they know what the maintenance schedule is. They know that they're going to get some break in the routine when the line goes down for maintenance, or when there's repairs that are needed, or when the equipment gets replaced. Everybody's excited about the new equipment. So they do have some changes in their environment that they look forward to on a recurring basis. But they know that by and large, every day is going to be like it was the day before. Maybe the volume changes, and then maybe they have new equipment and more equipment, so they have more people. If it's more like a retail environment, then the people in operations are going to be more like the sales and marketing personalities, because they work the floor. They make sales on the floor. So they see customers every day. They're going to answer the same questions every day, because new customers have the same questions as the customers that came in yesterday. But every day is a new challenge. They have sales going on all the time. They have end of season changes. They have new seasons where inventory changes. So they're more like the sales and marketing people than they are like the administrative people. So you have three different personalities that are in your business. And I can tell you that the people that are in this area, marketing and sales, are not going to be happy working in administration, and they may not be happy working in operations solely. You have inside salespeople and you have outside salespeople. If you have outside salespeople in your employ, they're not going to be happy working on inside sales. And they're not going to like that restriction, that consistency. They like going out, seeing new people and new places every day. So people who work in your business need to be placed in the right positions. As the owner, you need to decide what you are good at, what you like to do, because as the owner, you are not going to be good in all three of these areas. And in fact, as the owner, if you're going to have a growing business, you're going to have to spend a significant amount of time building your long-term strategy, knowing what you want to do next year, next 5 years, where you want to be in 10 years. You need to build a strategy, and you need to focus on that. And that's a mindset that's way different than marketing and sales or operations or administration. And I can tell you that nobody is good at more than 2 of these 4 points. And I'm telling you that you have to be good at long-term strategy as the entrepreneur, as the head of the company. So at most, you can do long-term strategy and maybe one other area. Now, I'm also going to tell you that the most successful companies have the owners focusing on long-term strategy only, and they delegate out all of the other areas of daily operations. So your goal is to hire people to run your business on a daily basis. So hire people for daily operations so that you can focus on long-term strategy. You're not going to be able to do that during startup. You're not going to be able to do it during stability phases. You may be able to start shifting during your growth phase. And certainly that's where you should be during your maturity phase. But if that's not where you want to be, then it's going to be very difficult for you to have a balance between your work life and your personal life, because you're going to be spending way too many hours in the operations, and you're going to have a tendency to get pulled in to doing things that you're just not comfortable with. If you're comfortable in the administrative functions, like an accountant is typically comfortable in the administration area of business, then you're not going to be comfortable when you need to delve into the marketing and sales function of your business. You're not going to see too many accountants that are good at sales. So they're good at operations, which is preparing taxes, preparing accounting statements. They're good at administration, which is keeping up with renewing their licenses and renewing their loans, their insurance policies. They're not very good at sales and marketing. So keep this in mind so that your personality is best placed in those functions of your business where you can maximize your efficiency, maximize your productivity, and therefore allow the company to maximize its profitability. And always look to outsource or to delegate those other functions of your business operations. So people ask me, as I'm a CPA, what's the difference between a bookkeeper and an accountant? Well, for one thing, bookkeepers tend to cost you less than an accountant. So let's get that out of the way. I am a CPA, so I don't want you to think that I'm trying to push you into hiring a CPA instead of a bookkeeper, because there is a place for both. I've already said that many companies hire a bookkeeper on a daily basis, and they hire an accountant on a periodic basis to come in and do those things that the bookkeeper should not be expected to do for the business. So let's go through that list. A bookkeeper should be someone who can post transactions daily. They need to post them correctly, timely, and consistently. If the bookkeeper does not know how to do that, then they're not performing the role for which they're getting paid. They can print the financial statements, but they don't often know how to interpret the financial statements. They can print the vendor payables list so that you as the owner know who you want to pay and when. So they can print out a list of all the people that you owe money to and when those bills are due, so that you can schedule out your vendor payables according to the cash that you have on hand. They can print out a collection report so that you know whether or not your accounts receivable is being collected timely. They can post recurring transactions to the general journal, but they typically are not very good at posting exception or correctional transactions. Typically, you need somebody with a little bit more skill to know how to post journal transactions that are non-recurring. What I do with my clients is that if they have things like an external payroll service that they use, or if they have an external point of sale system, I will set up a template for their general journal entries. And I will show their bookkeeper the payroll reports or the point of sale reports or the reports from these external systems that are generated on a periodic basis. I will show them where on those external reports to pull the numbers that go into the general journal templates and how to post those general journal entries from the templates on a regular basis so that they're consistent, they're timely, and they're accurate. And so the bookkeeper doesn't have to understand why those numbers are placed in that order. They just need to know how to place those numbers in that order. Things that an accountant can do for your business, they can reconcile the bank statements so that you have a segregation of duties if you only have one bookkeeper. They can help you calculate the financial ratios or show you how to do that so that you can do that internally through your staff. They can help you identify operating exceptions like payroll overtime, low inventory turnover, the asset status to make sure that you're recording your depreciation correctly. They can look at financial trends. Is there a sales increase or decrease that's consistent with the cost? In other words, is your cost increasing but your sales decreasing? That's a problem because that's a change in your margin. They can help you identify slow-moving inventory or they can help you establish a link between your external systems. These things have value. They may not have value to you on a daily basis. So maybe hiring an accountant is a costly basis for your business, or maybe you're at the point of your development when you can generate the need, you can see the value for having an accountant on staff full time. So you elevate the role of the bookkeeper to the role of the accountant, so that the accountant performs everything that a bookkeeper performs, plus the role of an accountant. Now, I say an accountant, and a CPA is an accountant. A CPA is a licensed accountant. What does that mean? Well, it means that a CPA has gone through a specific number of courses in college and has also passed a very rigorous exam to qualify for to obtain a license. An accountant may or may not be a licensed CPA. It doesn't mean that an accountant doesn't have the skills that a CPA has. It just means that a CPA has proven to you through their efforts and through their licensing that they have a certain amount of skill that they bring to your company. An accountant may or may not have that level of skill, and you have to determine whether or not that accountant has the required level of skill that you need for the business. And an unlicensed accountant will probably cost you less than a licensed accountant, a CPA, and a bookkeeper will probably cost you less than an accountant or a CPA. So use these resources appropriately, and it'll be an investment in your business, not an expense. It'll help you to generate more profit over the long term. So from that, we now have some time for Q&A. If you have any questions, feel free to write them in or to unmute yourself and ask, because I think the best way for you to learn is to ask questions or to listen to the questions that other people have, because typically when someone else has a question, it's a question that can affect or improve your own business. So does anybody have any questions at this point? Deadly silence. Is anything unclear about what we covered? Or was there not enough detail that maybe we can dive into a little bit more from the materials that you've seen? Again, deadly silence.
Yes.
I know that most of you are muted. You can unmute yourself if you want to ask a question, or you can type into the chat box if you have a question. All right, I don't want to belabor this point. If no one has any questions, we did go through quite a lot of information. I know that most people, when they see this information for the first time, it's a lot. It can be overwhelming, because we tried to give you a very wide range for the time frame that we have. We do go through the same material through the SBDC in future months and some of the programs that we have. So let me slip the last slide in here. This is the phone number that you can call if you want to get on their schedule. You can call this number to arrange a consulting session for someone to talk to you about the challenges that you have in your business. You can call this number to get on the schedule for any of the training programs. You can log into the SBDC website. It's louisianasbdc.org, and look at all of the programs that we have on a monthly basis. Again, the programs of the SBDC are not meant to compete with the programs of the City of New Orleans. The programs that the city is offering have their own value built into them. So I would encourage you to attend both of the groups of training programs to get the maximum value for your own business. If you're not learning, then your competitors are moving ahead of you. So can we start from scratch with bookkeeping today? We don't have good records from the beginning of the year. Yes, you can, because you have receipts, you have your checks, you have your credit card statements. Unless you paid cash for all your transactions and you didn't keep any receipts, then yes, you can start your bookkeeping system today. even if you hadn't started from the beginning of the year, you can backfill your accounting records from today. If you're moving to a new accounting system, it's always best to start with the new accounting system at the beginning of the year. So what most people do in December, they'll record transactions into the old system and the new system so that they can make sure that the recordings that they do in the new system match the recordings that they have in the old system, so that they know that they're using the new system correctly. And then starting in January, they'll move on to the new system exclusively. But you can start mid-year. It's just a little bit more complicated. And I do recommend that you do that with someone who's skilled at doing that, someone who's done that before. And typically that's going to be an accountant, not a bookkeeper, who can help you do that. It may be, well, in accounting software, usually don't have people that are not accountants selling accounting software. So whoever is selling you the accounting software should be able to help you transition to the new platform, either mid-year or at the beginning of the year. But yes, you can start today. If you don't have good record keeping, today's not a bad day to start.
I see that Mark had a question. He unmuted himself.
Go ahead, Mark.
Yeah, this is Mark. I've actually been in business for 39 years and almost ready to retire.
Congratulations.
But I have Mark's Muffler Shop in the Lower Ninth Ward, by the way. But just keep it simple. That's all. I've always done it. I've had one location for years. I briefly had two locations, and whatever location I was at, I made money, and the other one lost money. So I ended up just giving a second location to a friend. But I keep it simple. I've always done my own books. I have a CPA that reconciles everything once a month, and she does all my year-end stuff. But I basically keep my daily sales reports and balance my checking account and give it to her once a month. And she does everything electronic. But yep, I'm ready to retire.
Good for you.
Keep it simple. That's my idea. If anybody wants to buy a location, my place is for sale in the Lower Ninth Ward, Mark's Muffler Shop. I talked to Margaret earlier. I was just here to plug myself, but
that's fine. It's a great time for an advertising. That's why
Yeah,
everybody should be online asking questions so they can advertise their business as well. I mean, you got a
Yeah.
captive audience here. I will tell you something about what you said, Mark, and I don't disagree with keeping it simple, but I would say keep it consistent. Not everybody can keep it simple. Not everybody wants to stay with a single location. Some people want to move to a different location. Some people do have a more complex business. If you're making your own products and selling your own products in like a retail environment, it gets more complex. If you're in a fabrication just means you're buying the raw materials and you're assembling them together. You're not making the raw materials, you're just assembling the materials. That gets a little bit more complex. If you're in a highly technical field, like a builder, like a contractor, that can get a little bit more complex. So instead of saying keep it simple, let's say keep it consistent. When you keep it consistent, you're going to simplify whatever level of complexity you have over time, because you're going to do the same things over and over again so that everybody can be as good at it as you are. And that becomes a more simple process to continue and make money at. So keep it consistent and it will become simple. But don't necessarily limit yourself unless that's your plan. For Mark, his plan was to keep it simple and to keep it in a way that he feels comfortable that he can control it, so he can continue to have the same level of income year after year. And there's nothing wrong with that. A lot of people do that. A lot of people have lifestyle businesses. A lot of people just have small businesses that they're comfortable with. It's called a mom and pop shop. There's nothing wrong with that. That's how most businesses is completed in this country. We have more small businesses than we have large businesses. In fact, 85% of the businesses in this country are considered small businesses. So that's the bulk of the business that we have in this country. So yeah, thank you for your comments, Mark. We do have
Thank
a
you.
question. Yes, absolutely. And congratulations on your success too. And congratulations on recognizing that there are other things in life that once you retire, you now can afford to do something different. You may not stop working, but you can afford to have options, and that's always great. We have another question. To keep it simple, would you recommend using credit cards instead of debit cards for a paper trail? I like the idea of using credit cards because you're using somebody else's money, as long as you make sure that you pay off the credit cards before the due dates on the statement, so that you don't pay any interest on the use of that money. So you're using somebody else's money for a whole month, and then you're paying off that balance at the end of the month. And you have both the invoices, which are the receipts that you get every time you use a credit card. And then you have a statement at the end of the month, which summarizes all of the invoices that you have, so that you have something to reconcile to. And also with a credit card, if you have a dispute because somebody made a mistake or because somebody tried to take your money, you have the credit card company to stand behind it so that you can dispute a charge and get your money back. With a debit card, you don't have that same level of dispute or problem resolution. And if you make a charge and the charge came across as a different number, then it's up to you to get that money back, to fight to get that money back. You can't just contact the bank and say, this is a mistake, give me my money back. You have to prove that it was a mistake. So the burden of proof is a lot more difficult. It's a lot higher on debit cards than it is on credit cards. And also, debit cards do provide less information on the bank statement. It does show the vendor, but not always a vendor name that you would expect on the bank statement. It could show a name that you don't recognize, and then you'd have to keep manual records to make sure you understand who that vendor was. Even though on a debit card, you probably have the ability to grab an invoice, a receipt for that debit charge. A lot of people who use debit cards don't ask for a receipt, or they don't keep the receipt. So you don't have the same level of documentation. So I hope I answered that question. Any other questions? All right.
Well, if there's no more questions, I know that was a lot of information. And as Mr. Melanson stated, the Louisiana Small Business Development Center do offer services to help you along with this topic and much more. I will share their flyer with everyone. I'm sorry.
I'll stop sharing my screen so you can share. Oh, okay. I don't think I'm sharing my screen anymore, so you should be able to show your screen. Okay.
All right. So that's their flyer. I would also send it out to everyone. I would like to thank everyone for joining today, especially our guest speaker for his awesome presentation.
Thank you.
Within 5 to 10 business days, this session will be available on the Office of Economic Development YouTube channel, along with previous recorded sessions. Our next session is tomorrow, June the 22nd. And our speakers are representatives from the City of New Orleans Bureau of Revenue and the Louisiana Department of Revenue. Remember to check your emails for all reminders, and I hope you guys can join us again. Again, my name is Margaret McGee. Don't hesitate to reach out if you have any questions, and everyone have a great day.
Bye, everyone.
Thanks.